Very good morning. Welcome back to ET Now. You're watching Market Cafe with me, Kanishka Sarkar and Shreyansi Singh. Over the next 1 hour, we'll get you top developments from India and around the world and also tell you about the stocks to keep on your radar today. Well, first things first, let's take a look at the handover that we are getting. Shreyansi, sixth straight winning day for both S&P and Dow on the Wall Street overnight.
Well, absolutely. A very good morning to you, Kanishka, and that sums it up. That's just about right. When you take a look at the longest winning streak since November that we have at hand, in fact, and you do have the 30 stock Dow, that's the one that climbed 300 points. S&P 500 as well gained just 0.6%, thereabout, sixth straight winning day, like you mentioned. For both of these indexes, the longest since July for the Dow and since November for the S&P 500. So that's the kind of handover that you have at hand. Other than that, there's of course the Nasdaq Composite. That's the one that gained 0.5% as well. And April, of course, has been a rocky month for the markets. You do have Trump's tariffs. In fact, that announcement on April 2nd that set all of these events in motion. About a volatile trading is what you saw coming in after that announcement. But the major averages have been gradually narrowing the month's losses. So consider that. The S&P 500, in fact, briefly entered a bear market territory as well back on April 7th. After that, you did have a little bit of a comeback that we've seen thus far. And it's down just about 0.9% for the month. That's the S&P 500 that I'm talking about. The Dow, of course, on pace for a 3.5% loss in the month of April, and Nasdaq about 0.9% higher. So that largely is the kind of picture that you're looking at as far as the markets are concerned, both on a daily basis and on a monthly basis. But Kanishka, definitely we can't rule out the recovery that we've seen thus far.
Well, absolutely. Well, US stocks have been holding fairly steady. Oil prices have fallen more than 2% yesterday as trade war concerns have dampened demand outlook. Now, Brent crude futures fell by $1.6 or 2.4% to close at $64 per barrel, whereas US WTI crude dropped about 2.6% to settle at $60 per barrel. Now, remember, these moves come as investors brace for OPEC Plus to boost output and worries that US President Donald Trump's tariffs would hit the global economy and slow demand for the fuel. Now, as per a Reuters poll earlier, Trump's aggressive tariffs on imports into the US have made it probable that the global economy will slip into recession this year. Meanwhile, China, which is hit with the steepest tariffs, has responded with its own set of levies against US imports, stoking a trade war between the top two oil-consuming nations. Now, analysts have sharply lowered their oil demand and price forecasts following these developments. In fact, UK oil major BP reported its results yesterday and a deeper than expected 48% drop in its net profit to $1.4 billion on weaker refining and gas trading. Now, remember, the energy market also awaits earnings from US oil majors ExxonMobil and Chevron this week. On the other hand, as per reports, several members of OPEC Plus are expected to suggest an acceleration of output hikes for a second straight month in June. Now, if you look at gold, on the other hand, it fell nearly 1% on Tuesday as signals of easing US-China trade tensions reduced some safe haven demand. This is while investors wait for key economic data this week to gauge the Federal Reserve's policy outlook. Now, spot gold was down 0.8% at $3,315 an ounce, whereas US gold futures settled 0.4% lower at $3,333. Remember, Trump's administration has eased the effect of auto tariffs by lowering taxes on foreign parts used in US-made cars and making sure imported cars are not hit with multiple tariffs. Now, such developments that hint at softening trade tensions have caused a sell-off in the safe haven gold, a traditional hedge against rising global instabilities, which had risen an unprecedented rally to notch a record high of $3,500 last week.
Well, absolutely, that's the picture, and that's what it's looking like as far as gold is concerned. When you take a look at the year-to-date moves, though, you do have gold that is up 25%. With that in mind, let's move on, take a look at the events that you should be watching out for, and it's Akshaya Tritiya back here in India. That's another reason to watch your channel, because at 1 p.m. today, we have special coverage when it comes to Akshaya Tritiya, as well as gold. Like I mentioned, gold is up 25% for the year, so that's one more reason to watch that particular show that I mentioned. But moving on, in terms of the global cues, you have from the US GDP as well as PCE price index. Other than that, there is employment cost index and ADP employment. So lots of data that you should be watching out for as far as the US is concerned. From the Eurozone, there's GDP, and from China, there's kicks in manufacturing PMI as well. From Japan, there's industrial production and retail sales data. So quite the data-heavy day, if you will, when it comes to the US, Eurozone, as well as China and Japan. But moving on, global earnings, Meta, Microsoft, Total Energies are the ones that you should be watching out for. And back home, in terms of corporate action, you do have Bank of India and Mass Financial Board. Those two boards will be mulling fundraise. Other than that, there's Indus Towers board that is going to be mulling dividend, as well as bonus or buyback, and that is something that you have to keep in mind. That particular counter, last day to buy shares to be eligible for dividend for ABB India, so even keep that one on your radar. Other than that, of course, there's US President Donald Trump marking the 100th day of Trump 2.0, and that is something that we're watching out for in terms of key commentary coming in from Trump as well.
Absolutely, Shranti. Plenty of cues to watch out for today. But on to the biggest headlines from the US this morning. Donald Trump has signed an executive order softening select auto tariffs that were implemented just earlier this month. According to the new tariff, 25% tariff on imported vehicles remains. Under the new order, however, additional 25% tariffs on auto parts that were set to start by May 3rd will also still take effect. But vehicles that go through final assembly in the US will be able to qualify for partial reimbursements on those levies for 2 years. Now, parts-related reimbursements include potential offsets of an amount equal to 3.75% of the value of a US-made car that's assembled before May 1st, 2026. After that, the reimbursement cap is lowered to 2.5% of the car's value until April 30th, 2027. Now, the administration has said it calculated those rates by applying a 25% duty to 15% of the value of a US assembled vehicle in the first year and a 25% duty to 10% of that value in the second year.
Alright, then that's a very important update coming in. Moving on then, meanwhile, the US president also said that trade talks with India on tariffs were coming along great and expects both sides to strike a deal soon. These comments come after Treasury Secretary Scott Bessent said that the US was very close on India. Do remember that US Vice President J.D. Vance also met last week with Prime Minister Modi. Let's also go across and listen in that excerpt.
We just wanted to help them during this little transition, short term. And during this little, if they can't get parts, it has to do with a very small percentage. If they can't get parts, we didn't want to penalize them. And they have a 1 year period and then they have an extra year, but it's for a very, very small part of the car. But basically, they're paying 25%. India's coming along great. I think we'll have a deal with India. The Prime Minister, as you know, was here 3 weeks ago, and they want to make a deal. We'll see what happens.
All right, and that's key commentary coming in from US President Donald Trump. In fact, in terms of key commentary at the bottom of your screen, in fact, you can see some other comments as well from him, because he's also talking about how India, France and China officials are coming to make a deal. Other than that, he's also talked about how if trade negotiations take too long, he's just going to be setting the price, and also talked about aluminum and steel tariffs that are going to be protecting the bedrock of the country. So that's some commentary coming in from US President Donald Trump. Also mentioned that he's going to be making a fair deal with China on trade. So, Kanishka, lots to take a look at in terms of the headlines and commentary.
Well, absolutely. That's some key commentary coming in as far as India is concerned. But now moving on, Trump has also resumed his criticism of the Federal Reserve, that claiming that Chair Jerome Powell was not doing a good job and that he knew more about interest rates. Now, speaking at a rally in Warren, Michigan, commemorating his first 100 days in office, Trump did not mention Powell by name, but largely hinted at his past criticism of the Fed chair.
All right, then moving on, let's take a look at some other news and updates. Meanwhile, reports in fact also suggest that China has waived the 125% tariff on ethane imports from the United States imposed earlier this month among a group of other products that have been granted exemptions. In fact, the move is going to be easing pressure on Chinese firms that import US ethane for petrochemical production, as well as provide an outlet for the natural gas liquid, a byproduct of US shale gas production.
All right, then moving on, let's get you some domestic updates. Prime Minister Narendra Modi has given complete operational freedom to armed forces in the wake of the Pahalgam attack, according to sources. Now, this is after the PM chaired a high-level security meet with Defence Minister Rajnath Singh, NSA Ajit Doval, Chief of Defence Staff General Anil Chauhan and other top officials. Now, the Prime Minister's War Cabinet meeting was followed by one-on-one meetings with Home Minister Amit Shah, RSS Chief Mohan Bhagwat. Now, these meetings also set the stage for a Cabinet Committee on security to convene once again today at 11 a.m. This will be the CCS's second meeting in just 7 days. Now let's go across to Sam to get all the details.
Between Prime Minister, the three armed forces chief were present, the Chief of Defence Staff as well as Union Defence Minister Rajnath Singh and NSA Ajit Doval was present in this meeting. But the big message that came out from this meeting that PM gave a full freedom to the armed forces, that they can decide the date, they can decide the target, and they can go with full throttle to take action against the terrorism or the terror outfit. PM has conveyed a big message that Indian government, the central government, has full faith and confidence in the armed forces capability, and government stands fully in support of the armed forces. So if they want to go for any action, then government is standing behind it and will fully support it. And armed forces, they have got full freedom to decide the day, the kind of action they want to take, the kind of target they want to choose. That all freedom has been given by the government. That sort of support will the government will extend to the armed forces. Now, this almost 40-minute and long meeting that went between Prime Minister and the armed forces chief, this was also a message to the global, to the international platform, that India will not admit any sort of intervention or so-called mediation from any third party. So India is capable, India is strong enough to handle these sort of situation. Yes, there has been a terror strike. Yes, there has been a dent on India's security forces. But yes, India will give a befitting reply, a strong reply. And that is the bold message that this meeting has been, through this meeting, the government wants to send. But after this meeting, that went for almost 40-45 minutes. The second meeting which started was between Prime Minister and Union Home Minister Rajnath Singh. And in this meeting, we are also picking up from sources that lately RSS Chief Mohan Bhagwat has also joined. And strategically, how government wants to move forward, that all is being discussed.
All right, thanks, Ami, for getting us all of those important updates. So it just looks like that armed forces have been given a free hand. That is the word coming in from sources. Remember that this is the second crucial CCS meeting in a week, and there's another one that is lined up at 11 a.m. Against that backdrop, we also caught up with Sanjeev Srivastava, who's a political commentator. Let's go across and listen in to what he had to say.
The entire nation stands behind the government and are giving, just like the Prime Minister has given free hand to the armed forces, the entire political spectrum has given a free hand to the government, that whatever they do, the opposition will also be in support, which is a very good thing. Honestly, believe the manner in which people were asked their religion and then targeted and killed, there was a clear pattern and design or conspiracy to foment communal sectarian riots in India, which the Indian social fabric stood intact. And unfortunately for Pakistan, fortunately for us, that side is fully covered, and as a nation we stand as one. And that is something which we need to guard as much as taking action against Pakistan or what we do now.
Well, that's the expert view coming in on India's measures as far as countering terrorism is concerned. Now, as the armed forces have a full operational freedom to determine the mode, targets and timing of India's response to Pahalgam terrorist attack, the experts say if a shooting war breaks out, the economic fallout could be severe. Let's go across and listen in to what Swaminathan Iyer, the consulting editor at ET Now, had to say about it.
So if a shooting war begins, it will affect our economy. If we avoid escalation, maybe it affects the economy only for a short time. If there is some further escalation, we have to see. I would say at this point of time, yes, the Prime Minister said the armed forces will be given freedom, but that is freedom at the border level. If you are going to actually have a strike, that cannot be given. That freedom cannot be given to the army. So if there is to be a strike, that will ultimately be political. as of now, as I said, things are under control from the point of view of most people. So fundamentally, they said, we have seen this movie before. Don't get into a panic. Don't think it's a trailer for a major war. The two countries are clever enough to handle it on their own. They will satisfy their respective publics that they have had victory. So both sides will claim victory and things will calm down. So I think this perception that I'm giving you is very different perhaps from the mood in India right now, where the feeling is we must hit back in some way and cause them some great damage. This may lead to a very major war. This is the kind of, I mean, there are some people in India who feel this particular way that we have to prepare for a major war. And, preparation is always a good thing.
Or rather, that's some important commentary coming in. In fact, moving on, days after a terror attack at Pahalgam that left 26 civilians dead, the tourism in the valley has taken a severe hit. You did have a select few tourists trickling back to Pahalgam, but you do, from aviation sector to hotels and hospitality sector, you do still have a turmoil that the entire region is going through. Without a sign of revival in the nearby future, the average airfare, in fact, for flights to Kashmir has dipped, in fact, by more than 50% and has come down to around 5,000 rupees during this peak season itself. Similarly, post the terror attack, the hotel industry has been hit hard with cancellation of bookings. That is resulting in huge losses. In fact, we took a look at some of these interesting developments. Let's take a look at what the trends then suggest.
The sound of bullets echoed for more than 10 minutes in Baisaran Meadow, and then everything fell silent. Hotels deserted. Restaurants empty. Tourism in the valley has taken a severe hit days after the Pahalgam terror attack that left 26 civilians dead. From aviation sector to hotels and hospitality sector, the turmoil is real and without a sign of revival in near future. The airfare for flights to Kashmir has dipped by more than 50%, with an average ticket now available only for 5,000 rupees during the peak season. Similarly, the hotel industry has been hard hit, booking cancellations resulting in massive losses. The terror attack has dealt a severe blow to the tourism and hospitality sector in the region. Heightened security concerns have led to a significant drop in tourist footfall and widespread cancellations of bookings. This has directly impacted the livelihoods of many in the valley who depend on tourism. The once bustling tourist spots now wear a deserted look, casting a long shadow over the industry's future prospects. According to local circles, a community social media platform, 6 out of 10 families have cancelled their bookings. The platform suggests that 62% of more than 6,000 respondents have cancelled vacations between May and December. The impact is indeed real. According to Babar Chaudhary, who's the president of the Jammu and Kashmir Hotels and Restaurants Association, at least 1.3 lakh bookings have been cancelled between April and August. Generally, 25 lakh tourists visit Kashmir between April and August. But 90% of expected tourists might not visit Kashmir this year. The aviation sector is also struggling, thanks to a sharp decline in air travel to Kashmir. As tourists cancel their trips en masse, airlines are witnessing a drastic drop in demand. Airfares have dropped substantially. Tourism in Jammu and Kashmir had been growing steadily for the last 3 years, with 2024 witnessing a footfall of almost 30 lakh tourists. Tourism alone accounts for about 8% of Jammu and Kashmir's GDP, and Omar Abdullah's government was hoping the sector would generate 50,000 jobs annually. But for now, all that has to wait as India calibrates its response to Pakistan-sponsored terrorism.
It's been a week of Pahalgam carnage, and the authorities have decided to close down 48 tourist destinations across the Kashmir as a precautionary measure. Out of 87 tourist destinations, 39 will be provided adequate security cover.
At the time of filing this report, India has already shut more than half of Kashmir's tourist spots. Bureau Report, ET Now.
Well, a very grim picture coming in as far as Kashmir tourism is concerned. But with that, it's now time to take a very short breather on this edition of Market Cafe. We'll be right back. Stay tuned. All right, then moving on, let's get you a quick Asia market check. Well, Asia Pacific markets are trading mixed this morning as traders anticipate a slew of key economic data in the region. Japan's benchmark Nikkei 225 is just up about 0.06%. Korea's Kospi, on the other hand, started in the negative territory today but is now up more than 0.5%. Australia's benchmark S&P ASX 200 is up 0.2%. Now, Hong Kong's Hang Seng Index is trading nearly 0.5% lower, whereas China's Shanghai is trading flat, slightly lower in the red territory. Now, remember, these moves in the Asian market come on a day when the Bank of Japan kickstarts its policy meeting today and is widely expected to hold rates at 0.5% when the meeting concludes tomorrow. Now, investors would also be waiting on a slew of key economic data in the region today. For instance, China will be reporting its PMI data for April, and Australia is expected to report its inflation data for the first quarter of the year. Apart from that data, U.S. Secretary Scott Bessent has also said that the Trump administration held substantial talks with Japan over a possible trade deal, and that the counters of a deal with South Korea could be coming together. Well, those are some of the developments that could be weighing in on the Asian market. Meanwhile, back home, the Nifty ended flat yesterday at around the 24,335 level. Now, this morning, the implied Nifty is pointing to a slightly higher opening around the 24,370 levels. Now, remember, this is a time when Trump has said that tariff negotiations with India are coming along great and that he believes the US will strike a trade deal with India soon. Well, those are some of the cues that we're tracking for the Asia market right now.
Absolutely. Let's see how that pans out for us. But moving on, then they say all that glitters is not gold. But well, when it comes to investing across asset classes, everything that is glittering certainly is gold. The yellow metal, in fact, is up 25% on a year-to-date basis. Thus far, gold has been a timeless metal. It has glittered through crises, wars, and even rate cycles. When uncertainty strikes, equity markets tumble, commodities cool off, and cryptos crack. That's exactly when investors rush to one metal, and that is gold. It has indeed proven to be a safe haven, a good store of value in times of political and geopolitical uncertainty. So with that in mind, let's take a look at this special report.
As gold continues to hit new highs in 2025, let's decode gold's extraordinary journey. From just $35 per ounce in 1970, gold has now crossed $3,300 per ounce in the global market, implying a 9% CAGR over the last 55 years. Gold's long-term story has been all about preservation of wealth, especially during uncertain times. In fact, the price return of the yellow metal has been at par with Nifty over the last 10 years, clocking an 11% CAGR, and even over the last 20 years, it is not far behind. Here's a fun fact for you. Back in 1990, 1 kg gold was enough to buy a Maruti 800 car. In 2005, the same gold could buy you an Innova. And guess what? In 2025, 1 kg of gold can get you a luxury BMW or an Audi. But will the price surge continue the way it has over the last 50 years? That, of course, only time will tell. So what's fueling the surge? Geopolitical tensions from Ukraine to the Middle East are lifting safe haven demand. Central banks globally continue to buy the yellow metal. Countries like China and India are steadily adding to their gold reserves. Negative real yields and inflation worries are also turning investors towards hard assets. Whether it's inflation, currency debasement, or geopolitical flashpoints, gold has always stood the test of time. But even when it comes to silver, price return profile has been equally overwhelming. ETF inflows in gold too continue to surge. Gold ETFs saw an inflow of $226.5 metric tons worth $21.1 billion in the first quarter of FY25, the largest amount since the first quarter of 2022. The active start of the year follows a modest net inflow to gold inflows in 2024 after 3 years of outflows caused by high interest rates. But while investors cheer the rally, it's the government of India that's now facing the heat, courtesy sovereign gold bonds that it has been issuing since November 2015. Gold prices have nearly tripled since then, and reports suggest government's liabilities under these schemes have now reached 1.2 trillion rupees. But has the surge in gold prices impacted demand? It certainly has. Jewelers Association says consumption demand fell by 8% in volume terms this wedding season. But on the flip side, investment demand has seen a steady uptick, driven largely by recency bias or FOMO, as we may call it.
As of now, the demand is slow by 8% in weight terms. So last year, if we had a demand of, let's say, 200 ton during the season, so this year we may see it around 180 tons or 182 tons. But if we talk in terms of money or in terms of value, then we are up by a 10 to 12%. So I don't see that the major impact on the demand has happened due to the higher prices. In fact, the people, those who sold because of the news that the gold is going to come down at 56,000, they are coming back to buy their gold.
As gold continues to dazzle on the charts, the question remains, is this the peak or just another pause before the next leg higher? Although gold has fallen nearly 6% from its record of $3,500 per ounce amid signs of easing trade tensions, brokerage houses continue to remain bullish. But whether you are a cautious investor or a market watcher, one thing is for sure, gold will always be worth its weight.
Well, gold definitely has stood the test of time with investment demand still looking up. But now time for a big corporate development. IndusInd Bank MD and CEO Sumant Katpalia has stepped down from his position after an external audit found that serious accounting lapses in the bank's derivative portfolio, which led to losses of close to 2,000 crore rupees. Now, sources say RBI is likely to have asked the bank's board to take action against Katpalia. Ankur Mishra joins in with all the details.
Yes, sources say that Reserve Bank of India likely to have asked IndusInd Bank board to take action after the report found that there was a discrepancy which was there in derivatives portfolio. In fact, the bank had earlier disclosed on 10th of March that there is a problem in forex portfolio, and after that 2 external auditors were appointed. One was for the quantification of amount and one was for the root cause analysis why this actually happened. In the recent external auditor report, it was found that yes, there was a problem in the accounting of a forex portfolio, and after that Deputy CEO Khurana resigned, and a day after Sumant Katpalia also tendered his resignation, claiming the moral responsibility on whatever happened. But now we understand that Reserve Bank of India will soon approve the committee of executives which will take the day-to-day decisions. Now this has happened after Sumant Katpalia was earlier given 1-year extension as MD and CEO, but the process for finding a new successor was started by the bank. The RBI was monitoring the same, and now Sumant Katpalia himself has tendered resignation, taking the moral responsibility on whatever happened in the bank.
All right, then trouble mounting for IndusInd Bank. So let's stay with the IndusInd saga then and understand what the timeline then of the trouble looks like, and what are the brokerages then saying about the future of the bank. Will this resignation pave way for much needed reforms, or will a shadow of uncertainty continue to linger? Sharad is joining in with the answer and some of the key details.
Yes, the series of events, if you look at it from 18 January itself, the CFO Gobind Jain had resigned. Arun Khanna, the designated CFO, there was another resignation on 31st January, and moving ahead, Suman Katpalia, he was reappointed again as a CEO for a year in beginning of March. Now the discrepancies started coming in the derivative account, especially in the adjustment in the forex. The promoters showed confidence in management in March earlier itself, and also interestingly PwC as an auditor also stated that the impact was lesser than estimated. That was supportive for the stock prices, but problems started coming in. Arun Khurana was discharged from the CFO responsibility on April 17th, and Santosh Kumar had become the deputy CFO. Also, the firm had actually submitted the reports coming on the forex discrepancy. These were the independent reports also, but the spate of resignations that continued. Now, recently, the Deputy CEO Khurana had resigned on April 28th, and most importantly, yesterday, the MD and CEO Suman Katpalia had resigned. So, the storyline is filled with lots of important issues coming when it comes to the realignment of management. But what lies ahead for IndusInd Bank? The important thing is there's a new committee of executives. May they fulfill the CEO's responsibility, and the committee, by definition, can act for maximum of 4 months as per norms. Then the new management, especially the CEO, has to be elected. Now, what the brokerages are saying, they are saying that they cannot rule out exits of other senior personnel as well, and RBI could have let CEO actually stay until a new appointment was made. Now, CEO may be appointed sooner than expected. That's what the brokerages are expecting. And interestingly, as per IFL, there are key catalysts also. There are certain potential candidates on the screen. If you look at, there could be Rahul Shukla. He's the head of Corp and business for HDFC Bank. Rajiv Anand is the deputy MD at Axis Bank. He had recently retired also in the public forum. This exchange filing, it was given by Axis Bank. Zareen Daruwala, she's the former CEO at Standard Chartered Bank, and even Anup Bagchi is the CEO at ICICI Pru Life. So there are certain candidates which IFL is expecting that these candidates might fructify to come in the top management of IndusInd Bank. Now, the potential RBI approval for the promoter is expected to increase the stake also. And interestingly, the quarter results, they are expected to report a loss when it comes to the company, and there should be a limited bearing on the stock price, and the stock could re-rate ahead of fundamentals if and when these two materials catalysts come on board. So this is the entire picture of IndusInd Bank and how the timelines have happened and what actually it means, what the brokerages are speaking about.
Thank you, Sharad, for getting us all those insights about the timeline of the IndusInd saga and also what brokerages are making of all these latest developments. But you know what, we also spoke to a bunch of experts on how this affects the bank itself. Listen in.
RBI has been an exceptional regulator of our banking system. Just this afternoon, I had occasion to mention in a very important group that the manner in which the banking system in India has been cleaned up has been absolutely remarkable. And it is one of the macros which has given India macro stability and has given our banking system great strength. Incidents such as these must be dealt with swift action and with contrition that has been shown by professionals. I respect them as well. But I would say that together it is the responsibility of each one of us as banking clients, as in whatever roles we are playing, to make sure that we prevent such issues from recurring.
The CEO, Mr. Suman, had a moral responsibility, and he has, based on that, he has put in papers. But what I want to say very simply, RBI has so many returns, so many information that RBI, I don't know, you ask any banker, they say it's hundreds of things that RBI wants. Now, repeatedly, RBI supervision, somewhere there is a lacuna which it is unable to detect. So the issue is this, RBI must also own some responsibility that yes, there were problems in my supervision, we have failed in our supervision. Otherwise, what will happen, this type of case keep on happening.
With an a day how much of money is at risk in derivatives, then it doesn't have sound processes. At the end of the day, they should have known. And the bank itself on its own admission says that they first spotted it in June 2024. So what were they doing for 9 months? It's not a small amount. It's not like a couple of crores which hid somewhere which some branch guy did. This happened right at the corporate office, right at the treasury, and it was a huge loss. And this is a very world risk management practices which have brought down large banks like Barings Bank, etc., etc. So to that extent, this bank also should have had good risk management practices. If they had not had, they should be held accountable. If they have had and have not flagged it to the board, they should be held. Either way, they should be held accountable.
Alright, then moving on, green just got a little easier to grade. Market watchdog SEBI has hit the refresh button on ESG rating norms easing rules with immediate effect. It's a move that could streamline the maze of disclosures and also bring a sharper focus to what really counts in the world of sustainable investing as ESG becomes the new currency of corporate credibility. SEBI's latest circular might just be the green light India Inc. was waiting for. In fact, my colleague Anurag Joshi is standing by with all of those important details on what's changing and why it really matters. Anurag, over to you.
Markets regulator Securities and Exchange Board of India has eased the rules for ESG rating. SEBI's circular on ESG ratings released is effective immediately. According to the current rule, the rater won't withdraw the ESG rating except where the rated issuer or entity is bound up or merged with another company. According to the rules proposed by SEBI, the rater may withdraw the rating if there is no subscriber for the rating as on the date of the withdrawal, and where the rated entity or instrument is part of a rating package like the Nifty 50, which continues to have subscribers, such a rating cannot be withdrawn. According to SEBI, the ESG rating provider may withdraw the rating for the rated entity on non-availability of the business responsibility and sustainability report. The rater may withdraw the rating if the ERP, which is the ESG rating provider, rated securities continuously it's rated for 3 years or half its tenure, whichever is higher. And such a withdrawal is possible where the ESG rating provider has received a no certificate from 75% of the bondholders for the rated instrument, and this amount has to be, this 75% has to be by the value of the security.
All right, then that's the word coming in. SEBI has hit the refresh button on ESG rating norms and the rules take effect immediately. But with that, it's time to take a very short break on this edition of Market Cafe. We'll be right back. Stay tuned.
Welcome back. You're watching Market Cafe on ET now. Let's get to the futures and options roundup. In fact, Ansh is standing by with just that. Ansh, over to you.
Well, in the previous session, Nifty touched this year high level but could not hold on to gains, but it sustained around flat levels. Also, if you see on chart, then it has been hovering within a consigned range. Also, if you talk about DMA levels, then 200 DMA seems to be acting as a very strong support because Nifty has been hovering just above it for 6 consecutive sessions, and this 200 DMA lies around 24,050 mark. If you talk about option trend, then we are seeing very active call writing happening at that 24,400 strike, indicating option traders are expecting some strong resistance around this level. So this is the level where we may face selling pressure, whereas on downside 24,050 seems to be acting as a very strong support. Talking about Nifty Bank too faced a strong resistance at around that 56,000 mark, and in the previous week as well it was facing resistance at the very same level. So this is the level where which is acting as a very strong resistance, whereas on downside 54,000 seems to be acting as a strong support because from last 7 consecutive sessions Nifty Bank has been within this range of 54,000 to 56,000. If we talk about index future, then here we are seeing that open interest has gone up by around 3%, indicating long unwinding. So bit of a cautious signal here. Whereas in index future, we are seeing that FII have actually net added their position, due to which the total long position has inched higher from 42.3% directly to 44.3%.
Thank you, Ansh, for getting us that F&O snapshot. But now let's shift focus to the earnings space. Now, retail major Trent has delivered a beat on its quarter-end results for the quarter ended March. Now, let's go across to Snehi for the fine print of those numbers. Good morning, Snehi.
Well, yes. So if you take a look at trends quarter four numbers, a surprising beat coming in versus our estimates. Let's take a look at the earnings fine print on a standalone year-on-year basis. Revenue has come in at 4,106 crores, which is up 28.8%. We were expecting 4,131 crores. So revenue is the only metric where we've seen a slight bit of a miss. Otherwise, you have PAT, EBITDA and EBITDA margins that have been beat versus street estimates. Net profit is coming at 350 crores, which is down 46.5% year on year. Remember, the base quarter had an exceptional item, so even if you adjust for that item, it's still a beat coming in versus our expectations. So looking good on the PAT front. EBITDA has also come in at 656 crores, up 37.5%, beat on this front as well. EBITDA margins, we were penciling in this to be at 14.7%. It's coming at 16% compared to 15% this time last year. So big beat on that front as well. Some highlights of their earnings. Trends portfolio now consists of over 1,000 big box fashion stores. Fashion portfolio like-for-like growth in quarter 4 has been in mid-single digits for FY25 and double digits. Remember, in quarter 3 like-for-like growth was in high single digits, so this has seen a drop. So this could maybe add some pressure to the quarter 4 earnings. They continue to build on their presence in metro and tier 1 cities. In terms of store count for quarter 4, they opened 13 and closed 3 West Side stores and opened 132 and closed 2 Zudio stores. So total count as of March 31 is 248 West Side stores, 765 Zudio stores. Star segment is also doing well. They've registered an operating revenue growth of 17% in quarter 4. And on a leaving note, Chairman Noel Tata has said that Star is well poised to deliver much consumer value and growth in the years ahead. So that's the earning fine print for Trend. Overall, a beat versus street estimates.
All right, thanks, Nee, for getting us that earnings fine print. But let's keep it going with earnings. Bajaj Finance is the one that came out with its quarter earnings. In fact, marginally missed estimates. When it comes to those earnings, the board in fact has approved a final dividend of 44 rupees per share and a special interim dividend of rupees 12 per share during the quarter. You do have a 4:1 bonus issue as well when it comes to the company. In fact, we do have Varun who's standing by to do the number crunching for us.
Well, so it's a missed quarter for Bajaj Finance. If you look at the NII, it has come at around 9,807 crores. We were expecting 9,866 crores, and also for the profit, it has come at around 4,480 crores. We were expecting the profit to come at 4,574 crores. Also on the PPOP front, it has a growth of 24.3%, but yes, it is a slight miss from our estimates. The gross NPAs and net NPA numbers, they are actually good. If you look at the gross NPAs, that has come down from 1.12% to around 0.96% this time. So that has been good. But for FY25, if you look, the company has missed its net interest margin, credit cost and profitability target. For FY25, the net interest margin has seen a compression of around 49 basis points, and the company says that the Q4 NIM is actually lower than the FY25 net interest margin. For FY26, the company has given a guidance of good profit growth in FY26. The AUM that is expected to grow by around 24 to 25%. Although for FY25, the AUM growth was 26%. So the growth expectation for FY26 is a little bit less than what the company has showed in FY25. Also, the company says that the cost of funds that is expected to come down by around 10 to 15 basis points, and this is on a conservative level, because of which the net interest margin is expected to be stable. If the cost of funds goes down further, then that could impact the overall net interest margin on a positive way. The company also expects the ROA to be in the 4.4 to 4.6 range in FY26, and also given the excess capital, the ROE is expected to be in the range of 19 to 20%. Gross NPAs, net NPAs are expected to be in stable range. But for long term, if you look, the company has reduced their ROA and ROE guidance. ROA has been reduced to around 4.3 to 4.7%, and ROE has been reduced to 19 to 21%. The company says the new business is doing good. The B2C business, that is also showing some signs of recovery. But yes, there are stress in some of the areas, because of which the company expects the overall growth to be less than 25, and also the net interest margin has seen a compression. Let's see what happens. But yes, the overall commentary, the company tried to give some positive commentary, but the overall growth prospects for coming year a little bit less than FY25.
As far as Bajaj Finance is concerned, even that particular counter will remain in focus in trade today. But let's get you the entire list of stocks that you should be keeping on your radar then.
Well, so let me start with Bajaj Finserv, because they have even given the numbers, and it's a weak set of numbers because the profitability has gone down by 3.2% on a YOY basis. Now BPCL, it's a mixed set of number for BPCL, because the revenues and profit has gone down, but the EBITDA margin, that has shown an increase of around 30 bips. CET, it's a weak set of number because the revenue has gone up, but the operational performance, if you look, the margins have gone down from 13.1% to 11.3% now. Star Health, if you look at the overall profitability, it has just come at around 51 lakhs. So it's almost a miss from Star Health as well. Now, India Mart Intermesh, the results are good because the revenue has shown a growth of around 12.8%. The EBITDA margins have shown a good growth from 28.1% to 36.7%, and profit has gone up by 81%. Now, in corporate announcement, keep an eye on Praj Industries because they have done a joint forces with ThyssenKrupp for polylithic and production in circular economy. So that's one of the stock that you need to keep an eye on. Strides Pharma, the company has acquired 4 ANDA in the US markets, and Alembic Pharma, the company has received EIR for one of its facilities.
Thank you, Varun, for getting us that list of stocks to keep on our radar today. But with that, we're completely timed out on this edition of Market Cafe. But stay tuned to ET Now as the market takes all the action forward.
If you like this video, then like, share and subscribe to ET Now.